Good morning, everyone. I am delighted to welcome you all to today's webinar. I'm Crystal Wright, a principal at Worrells, and I am coming to you today from not so sunny Wollongong. Before we begin today, I would like to acknowledge the traditional custodians of this land, the Dharawal country, and pay my respect to elders past, present, and those emerging. I would also like to extend this acknowledgement to the diverse Indigenous cultures and communities represented among our virtual attendees today, acknowledging their custodianship of the lands from which they join us. I am very excited to announce our presenter today, Jo-anne Hotston. Jo-anne is a sought-after corporate trainer and presenter with over 25 years' experience in the tax industry. She's also a Fellow of the Chartered Accountants Australia New Zealand, a Chartered Tax Advisor with the Tax Institute, and holds a Master of Taxation from the University of Sydney. Jo-anne is known for her engaging and practical style, and she is a regular presenter with major professional associations, including Chartered Accountants Australia, New Zealand, and the Tax Institute of Australia. Jo-anne is sure to share some valuable insights with us today. If you have any questions for Jo-anne, please pop them in the chat or the Q&A function, and we will try to answer them all together at the end of the webinar. Please join me in welcoming Jo-anne to the webinar.
Thank you, Crystal, and thank you for all of those who are online today. This is an essential tax update. So in 1 hour, I've sort of had to figure out what I think is essential for you to know, which is very difficult because most of my in-house clients get to see me for 2 hours every single month. So hopefully I've chosen things which might be of relevance to you. So I'll just start off very quickly with thresholds, a few things for the year ended June 2023. I'll assume you haven't finished all of those tax returns yet, and a couple of things for 2024. Then we'll move on to cases. Some quite interesting cases to look at today, a little bit on rulings, and just a bit of an update on where are we up to with this issue in relation to payroll tax and medical centres. I will apologise that my focus on that is a little New South Wales centric, but I'll mention what's happening in Queensland and Victoria as well in that space. So just looking at a couple of things for year ended 30 June. Depreciation, not necessarily a highly exciting topic, but obviously over the whole corona period, we had all sorts of concessions given to our clients. The main one of those, which many people had continued past some of the other ones, remember we had the 50% accelerated depreciation, and that all ended a long time ago, what seems like a long time ago now, but temporary full expensing ended at 30 June. So from the 1st of July, it looks like we have an easier time of depreciation. All we have is the so-called normal depreciation rules that have always been in the legislation, looking at how much did the asset cost, what is its effective life, am I going to use diminishing value or prime cost, how many days during the year was it used, installed, ready for use, etc. Now, small businesses, aggregate turnover of less than $10 million, they have the choice to use normal depreciation, or they can use so-called simplified depreciation, which of course we've had for many, many years. Simplified depreciation, the instant asset write-off in the legislation is $1,000. That's always been the amount. But of course, successive governments for the last probably 15 or more years have given us various temporary thresholds. Now, the current government have a bill before Parliament, which for this year only will temporarily increase that instant asset write-off to $20,000. So on 1 July next year, we revert back to $1,000, but of course, sometime before then, it may well happen the government gives us another temporary increase of an amount. Now, the other thing with simplified depreciation, though, is anything that you don't get the instant asset write-off for, you have to pool. And your opening balance, if you're coming into simplified depreciation for the first time in this financial year, all of those assets which might have written down values of various amounts, you also have to put those into the pool. And just a reminder that if your client chooses simplified depreciation, it's an all or nothing choice. So you don't get to depreciate some things under so-called normal rules and others under simplified. You either buy the whole simplified package or you don't buy it at all. All right, car depreciation cost limit. Those are the thresholds for 2023 and the new one for 2024. Medicare low income thresholds, probably don't really need to know those, but the amounts below which various singles, families, etc., don't need to pay any Medicare levy. The luxury car tax threshold, once upon a time, most of us didn't care unless we had clients who were running car dealerships, in which case the threshold was relevant. But of course, now that we have the new FBT exemption, in fact, I saw a number plate on a Tesla the other day that said FBT, and it didn't say 000. It had 63 something or other on it. So I don't know if that was the person's date of birth, but it did make me think maybe I should look to see if there is still the number plate available, FBT 000, because these cars are FBT exempt. Now, of course, to qualify for that, though, the price of the car has to be less than the luxury car tax threshold for fuel efficient cars. So you can see there that from the 1st of July of this year, that threshold's gone up by quite a bit. So that gives you a little bit more to manoeuvre with the cost of some of those cars. And I'm sure many of you have had clients who have looked at that. Now, this actually worked very nicely for 30 June 2023, where you had potentially temporary full expensing measures. New South Wales government was still paying their $3,000 grant. They possibly still are, I don't know. Admittedly, there's a separate threshold around that one. Then you end up with an FBT exempt car. But anyway, let's move on. Okay, full disclosure. I actually got a Tesla on the 23rd of June. We're not completely in love yet. I still have range anxiety. I'm about to take it on a bit of a trip on the weekend. We'll see how that goes. Anyway, okay, cents per kilometre for car expenses, for individuals claiming car expenses. Not surprisingly, that's gone up a reasonable amount between 2023 and 2024, because obviously so have the running costs and in particular petrol. Working from home, the Commissioner updated his PCG practical compliance guideline for the 2023 year and said we'd now have a 67 cents per hour rate available for 2023. He's not yet released the 2024 rate, but he normally tends not to do that until towards the end of the year. Of course, the special COVID rate, that ended when you did 2022 tax returns. So for 2023, you've got an actual claim, if anyone can actually do all the actual record keeping for their electricity, etc., or you've got this sort of shortcut method, which gives you effectively a deemed claim for electricity, gas for lighting, heating, cooling, etc., your internet, mobile phone and or home phone expenses, stationery and computer consumables. The taxpayer, though, is able, if they use this shortcut rate, to still do a separate claim for the decline in value of other depreciable assets used from working from home, so their computers or whatever. And they don't have to necessarily have a dedicated workspace to be able to claim this cents per hour rate. Interestingly, the Commissioner's just amended this one and said if the employee is getting some sort of an allowance or reimbursement from the employer for working from home, they can still actually use this 67 cents per hour rate as long as they're not getting reimbursed for all of their expenses from working from home. So that's kind of interesting. Now, of course, the biggest issue with this PCG is the change in record keeping, which I'm sure by now most of you are aware of. Once upon a time, the Commissioner's previous PCGs used to say, just do a 4-week diary representative of your normal working week, and you can extrapolate that to work out how many hours during the year you work. Now, when he released this one, he changed that 4-week diary and said the worker, the taxpayer, needs to keep actual diary records from the 1st of March for every single day they work from home. The first criticism of this is for the 2023 year, a lot of employees probably had no idea that the law was changed, or not so much the law, but the Commissioner's administrative practice had changed. And I mean, at the very least, this should have started on the 1st of July, in my humble opinion. But the other thing is, how many people will actually keep those detailed diary records? I'm working from home. You might be able to tell from the background, I'm not actually in an office. I'm not going to tell you how good I am at administrative functions. I'm an okay tax presenter, but I'm pretty lousy often at the associated paperwork. Okay, let's go to companies just for a moment. For 2023, many of your companies will be base rate entities. carrying on a business and having less than 80% of its income from base rate passive, or where it also applies as a company that only came into existence for the first time in 2023. Now, why I'm talking about this briefly is for a number of years, we've had so-called carryback company loss provisions. And the 2023 tax returns are the last year in which those carryback loss provisions will apply. So you could potentially have losses from the 2020 year and being offset against taxable profits from the 2019 year and generating those refundable offsets. I'm sure many of you have in the last few tax years had occasion to use these provisions for your clients. But 2023 is basically when they end. All right, so you need to have had a tax loss in either of these 4 years and have had positive taxable liability in either of those 4 years. The amount of the refundable offset is the lesser of the loss from the relevant year multiplied by the company tax rate in that year, or the credit balance of the franking account at 30 June, or whatever tax was paid in those earlier years. So it's the lesser of those three things. And just a quick reminder of what was the corporate tax rate in those previous years. Well, if the entity was not a base rate entity, 30%, at least that's easy, it hasn't changed over the years, but obviously base rate entity tax rates have changed every year since 2020. So that's just a quick reminder of if you're doing that, working out the lesser of the amounts, etc., and needing to apply the previous year's tax rate. All right, so company loss carryback provisions over for 30 June. All right, after 1 July. One of the things that's been getting a little bit of airspace is the Division 7A benchmark interest rate for this year. It has clearly gone up by a significant amount compared to 2023. So it's now sitting at 8.27%. Is this good news or bad news? Well, normally paying more interest is not good news. However, in a private company scenario, if mum and dad have borrowed those funds for some sort of tax deductible purpose, for a share portfolio, fund a rental property or whatever, they'll obviously have a cash flow issue having to pay more interest into the company for 2024. But mum and dad would now potentially have a tax deduction at 8.27%. Yes, the company has assessable income at 8.27%. Most likely that company's a base rate entity taxed at 25%. We'll assume mum and dad's marginal tax rate is potentially 47%. So there's some nice arbitrage there. The other benefit is whatever amount of interest mum and dad are paying into the company, at least that stays with the company and potentially gives rise to maybe franked dividend income in the future. Now, because the interesting thing with franking is for your older clients who, and let's face it, statistically, there's a lot of those dreaded baby boomers out there who may eventually retire. And when they do, they'll potentially be living off tax-free income out of their superannuation funds. And if they have companies with a bunch of retained earnings and franking credits, you can start drip feeding those dividends out to mum and dad, and there may be very little or no top-up tax for mum and dad to pay because they've got a tax-free income stream if they're over the age of 60. So for baby boomers, accumulating retained earnings, paying a bit of corporate tax, probably not necessarily a bad thing. Now, obviously, for younger taxpayers, if you're paying them out dividends, they're probably going to have top-up tax when you're franking at 25%. What about the mum and dad who have borrowed out of their private company for private consumption? And let's face it, that's what a lot of Division 7A loans are for. Now what we've got is 8.27% of non-deductible interest in mum and dad's hands, still accessible to the company. That rate is possibly significantly higher than what mum and dad might be paying on their private mortgage. So is it a better option? I'm not saying it is. This is obviously a case-by-case scenario, but is it a better option maybe to draw down against their home loan? Now, having said that, though, even if you're paying less interest to the bank, you'll never see any of that again. If you pay the interest to the company, well, again, it's still sitting in the company's retained earning reserves and generating franking credits in the future. But certainly, apart from any of the tax considerations of what's better and what's worse, if mum and dad continue with those Div 7A loans, there will be the need to make larger repayments in 2024. Sometimes those repayments are made by declaring dividends to mum and dad equivalent to their Div 7A principal and interest repayments. That then creates, obviously, in mum and dad's hands, more assessable income, etc. So a lot of considerations around this. Probably something to be considered before 30 June 2024. Mind you, we're already, dare I say it, almost halfway through actually, it's not quite halfway through the financial year, is it? I'm exaggerating. We're only at the almost at the end of the 5th month of the financial year. 4th month. Okay, lodgment amnesty. Now, this was announced in the budget earlier this year. The government and the tax office in particular have a feeling that during COVID, a lot of business clients and possibly non-business clients as well got behind in a lot of their lodgements. Now, this amnesty is only directed at business clients, though, small business entities, so group turnover less than $10 million. And what it's basically saying is if your client lodges their late BASs that they hadn't lodged, back in December 2021 or whatever, and they still haven't lodged it, there would normally be a lot of late lodgement penalties. There'd possibly be an interest component if there was an amount to pay. This amnesty, now the amnesty though ends on the 31st of December. So we've only got, a couple of 2.5 months before this amnesty runs out. And it only applies to documents, tax documents, which could be BASs, could be income tax returns, could be FBT returns, which are outstanding from the 1st of December 2019 through to the 29th of February 2022. So if your client hasn't lodged their June 2022 BAS or their June 2022 income tax return, they're not getting the benefit of this amnesty. So there's a very definite a finite period from when the late lodgements are accrued, and they need to be done before the end of December of this year. So, as I said, only applies to SBEs. Now, the other one that changes, but this doesn't change until 1 July 2025, which once upon a time that sounded like such a long time away, the amendment period. Now, the amendment period for most small business entities is 2 years. And there are some exceptions to that if the small business entity has so-called complicated affairs, so there's more than 10 entities in the group, or there's any foreign ownership, or any of the entities in the group are owned overseas incorporated entities, etc. But generally, small business entities only have a 2-year amendment period, and that washes both ways for the commissioner and for the taxpayer. What the proposal is it will allow small business entities to amend their tax returns for up to 4 years. Now, this is an interesting one, and I don't get to say this very often. This is one where the commissioner, he doesn't get the same advantage. So if the normal amendment period is 2 years, the commissioner will still be stuck with his 2 years, but small business clients themselves, the taxpayer, will be able to amend their returns for up to 4 years. Interesting. But anyway, not yet legislated, doesn't start for a little while. Okay, what else did the budget announce? Now, this is currently a bill before Parliament, the so-called Small Business Energy Incentive. It only applies for the current financial year. This applies to businesses small and medium, so up to $50 million in group turnover. It's one of those 20% boost deductions with a maximum expenditure of $100,000. Now, it's all about encouraging businesses to become more fuel efficient. So when you go through this, so the classic example I've been using is you have a client who has a coffee shop or a restaurant, and they currently use a gas cooktop, and they decide to get rid of the gas cooktop and put in place an electric cooktop. Well, that electric cooktop will be considered to be more fuel efficient. You will go ahead and depreciate the cooktop as you normally would. So that will be either ordinary depreciation or maybe simplified depreciation. And then on top of that, there will be a 20% deduction. So if, for example, this commercial cooktop costs $5,000, you'll depreciate on $5,000. So I'll call it $5,500. You've claimed a $500 input tax credit. You've depreciated on the $5,000, and then the taxpayer would be entitled to 20% of $5,000. They'll get an extra $1,000. I hate doing maths in my head when I'm talking. Hopefully I got that amount right. But anyway, 20% of $5,000 will be $1,000. It gets a little trickier in terms of, well, what if your client is doing a completely new fit out of a kitchen for their restaurant or their coffee shop. So they're not replacing the old gas cooktop with an electric one. All they need to do is show that they have chosen a more energy efficient cooktop than some other choice. Now, first of all, fossil fuel equipment is completely out. Electric cars are out. Solar panels are out. All right, so let's go back to the new kitchen. So we could have used a gas cooktop, but we've chosen to use an electric one. That'll be enough. So you don't have to be replacing the old gas one. But let's go to the dishwasher. You go to the dishwasher in this restaurant. Well, as far as I'm aware, I could be wrong, but as far as I'm aware, there's no such thing as a gas-generated dishwasher. So your client's looking at electric dishwashers, and they only have a choice of electric dishwashers. Now, obviously, they all have different energy ratings, don't they? So all your client needs to show, this is going to be your problem doing a tax return, is they've chosen this commercial dishwasher, which I'll again make cost $5,000 so I can attempt to do the maths. Is that more energy efficient than another dishwasher they could have bought? Well, in other words, don't buy the lowest grade, because then you're going to have a problem. You as a tax agent, you're going to become suddenly an expert on energy efficient appliances. All right. So at the end of the day, though, 1 year only and a maximum $20,000 deduction. So some of your clients possibly won't get too excited about this. All right, FBT and electric cars. So currently, yes, FBT cars acquired, meeting that, the luxury car tax fuel efficient threshold, blah, 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 are potentially exempt fringe benefits. Currently, plug-in hybrids also come within that. However, from the 1st of April 2025, plug-in hybrids will no longer be FBT exempt. Now, there will be grandfathering. So if an employer has provided a plug-in hybrid today to employees, and it meets the various conditions, it's FBT exempt, it will continue to be FBT exempt after 1 April 2025. So it'll only be the employer providing additional plug-in hybrids after 1 April 2025, where there will no longer be that FBT exemption. Part 4A, the government, there's no legislation on this one yet, but the government in the budget said they will amend Part 4A to amend the tax avoidance rules, particularly in relation to some foreign issues. So one of the amendments they're looking at here is schemes designed to access a lower withholding tax rate, where things like fully franked dividends are paid to foreign residents. Now, that I would suggest is probably the fallout from the Guardian decision. Remember the Guardian case, which prima facie was a case on Section 100A, but the Commissioner also argued potentially Part 4A in that case. But the Commissioner's main argument was a trust reimbursement agreement. Remember, we had a discretionary trust, made a company presently entitled to trust income. So entitlement went from the trust to the company. In the following year, that company chose to pay its retained earnings reserve, being dividends and being fully franked dividends, back to its shareholder. Who was the shareholder? The shareholder of that corporate beneficiary just happened to be the same discretionary trust. That discretionary trust then was in receipt of fully franked dividends, which it streamed under its power of streaming in the deed to a beneficiary, Mr. Springer, who was a non-resident and who just happened to reside in a lovely, sunny and relaxed location called Vanuatu, which just so happens also to be a tax haven. All right, now the Commissioner lost on the Section 100A aspects of that. He did have a win for some of the latter years on Part 4A, but basically I sort of sympathise a bit with the Commissioner on this particular case, where, there was a fairly deliberate set of tax planning put into place. Originally, this particular trust had different corporate beneficiaries. It introduced a new corporate beneficiary. It got out of Part 4A, though, through part of the normal commercial, there was a reason other than tax advantages, because Mr. Springer was getting ready to retire, and he wanted some clean skin entities. Anyway, I'm not going through the whole of the Part 4A case, the Guardian Section 100A and Part 4A case today, but I suspect that's where this particular amendment has probably come from. It will also look at schemes which reduce the Australian tax benefit, where the scheme is designed to reduce foreign taxes paid. So it'll come at it from both angles. So it'll be interesting to see what this legislation looks at. Now, lump sums in arrears. for employees. Once upon a time, that wasn't really very topical, was it? But my goodness, over the last few recent years, it's been very topical with various employers having to pay lump sums for not having paid their employees properly. I don't want to do the whole name and shame, but, I think 7-Eleven was one, and Woolworths recently was one, and BHP's recently another one. Now, of course, the issue is when your employee gets a lump sum of outstanding wages, let's assume they get it today, it's assessed in the year it's received. And potentially, if it's a very large lump sum, so if we go to BHP, for example, if some of those payments, for example, are going to people working in the mines, whether you're a qualified mining engineer or someone doing sort of, the more coalface type, no pun intended, work, those salaries are usually fairly large. So I would imagine, compared to maybe someone working, part-time in a 7-Eleven store, I would imagine some of those lump sums are going to be relatively large as well for those unpaid or underpayments of prior year's wages. And what that can often do is push the person into a higher marginal tax bracket. I've just realised the BHP one's probably not a good example because a lot of those workers are probably already in top marginal. But if you were someone in a lower marginal tax bracket, 32.5 or 37 or whatever, then what there is available already is this so-called lump sum payment in arrears tax offset. So that is actually a particular offset you don't get to claim on a tax return. It probably should be part of individual tax returns going forward because there's been so many of these. It's actually a lump sum that you as the tax agent have to apply for specifically and separately. But what's going to change, but not till 1 July 2024, is the lump sum in arrears tax offset is looking at the income tax aspects, but there's no exemption for Medicare. So in rare situations, and this could be maybe the 7-Eleven workers who worked very part-time, in the year when they actually performed the services, they may have had income low enough to exempt them to give them either a full or a partial Medicare exemption. This won't be the BHP employees. But when they get their lump sum, it pushes them over those thresholds, which were on one of those previous slides. The legislation will be amended for those lower income earners so that if in the previous 2 years they had a full or partial Medicare exemption, in the year they get their lump sum that pushes them over that threshold, they'll potentially still get the lump sum payments in arrears tax offset, and there will also be that same Medicare exemption. All right, so it starts to get a bit messy, doesn't it? But anyway. Now, residency changes for New Zealand citizens living in Australia. The government have said we're going to allow Kiwis to take up citizenship. Once upon a time, they were able to become citizens of Australia, and then there was some, diplomatic stoush over something, which I've now forgotten what that was. And the government of the day, I don't remember what flavour the government was of the day, said, well, if you're going to be like that, we're not going to allow your people to take up citizenship. Now, basically, a lot of Kiwis didn't care because they've been able to come here and stay here indefinitely. They come on this special category visa, which is not something they apply for specifically. It's just like they arrive and it's kind of floats around in the background. And it doesn't limit how long they can stay here, etc. But if they've wanted to take up citizenship, they haven't been able to. So we're now going to offer them citizenship. Now, before we all go, yay, if you're a Kiwi, I'd really like to be a citizen of Australia. Just remember, how does this affect you for tax? So I'm not going to get into the whole debate on immigration and blah, 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 because that's not my area of expertise. In fact, I only know one thing in life, and that is tax. So currently, those people would be taxed as temporary residents for tax purposes. Now, what is a temporary resident for tax purposes? You sort of get the best of both worlds. Normally, if you're a resident of Australia, you're taxed on your worldwide income, worldwide capital gains. If you're a non-resident, you're only taxed on Australian-sourced income and Australian-sourced capital gains, which we call taxable Australian property. However, if you're a temporary resident and they're to get that status for tax purposes, it's not the immigration status as such, it's the tax status. You need to be on one of several specific visas. The most common one of these, apart from our Kiwis, was the Section 457 skilled worker visa. And basically, when you're a temporary resident for tax purposes, you only have to pay tax on income sourced in Australia and capital gains sourced in Australia. So you don't have worldwide taxation. So that could be good news. However, if these people decide to take up, citizenship, then they will be subjected to worldwide taxation. Now, for a lot of these people, they probably don't care. They came here when they were 19 years old. They don't have a whole bunch of property back in New Zealand, etc. So it doesn't really matter. But if they do have assets in New Zealand, of course, one of the attractions of capital assets in New Zealand is there is no capital gains tax in New Zealand. Currently, as a temporary resident, if they sold their New Zealand assets, they'd be outside the Australian tax net because New Zealand assets are not taxable Australian property. But as soon as they take up citizenship, they'll become residents for tax purposes and they'll be needing to declare their worldwide income. The other one to be careful of is trusts. Now, I've forgotten the number, but someone wrote an academic article I was reading when this was first announced on how many trusts there are in New Zealand. And I was staggered at the number of trusts there are. At the time, I thought, I didn't know there were that many people in New Zealand. But the relevance of that is someone could be living here, temporary resident, then they take up citizenship, then they get transfers out of foreign trusts. Now, this can happen for anyone becoming an Australian tax resident where there are overseas trusts and there are amounts of capital distributed out of those trusts. You need to be mindful of Section 99B, which is it's not that complicated really, but it's one of those often overlooked provisions because it's all about international tax. People come here and they think, oh, that's okay. I can just transfer money out of my bank accounts in Singapore or whatever. Depends where it's coming from. All right, so just be careful of trust transfers. Superannuation. Just very quickly, what are the various thresholds for the 2024 year? Well, your CGT cap, that is the CGT small business concession cap, has gone up to 1.705. Obviously, super guarantee is now at 11%. I'm not going to read through all the rest of those. Your general transfer balance cap, the one at the end of the slide, is now $1.9 million. But leading into that, people doing non-concessionals. Remember, we always have to look at the opening balance of their superannuation entitlements across all of their super funds that they might have, whether they're in accumulation mode or whether they're in pension mode or income stream mode, makes no difference. You need the market value of those assets at 1 July, which of course, here we are in the middle of October. You possibly still don't know what that figure is. But if your client is wanting to do non-concessionals, then they need to make sure their total superannuation balances are less than these particular figures. So if we start at the bottom of the table, if somebody at 1 July this year already has $1.9 million of total super assets, they can't do any non-concessionals at all over. Now, if it's between 1.79 and 1.9, they potentially can do 1 year, blah, 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 all the way to the top of the table. I kept thinking I should invert this table. If someone's got less than 1.68 million, so your client's got $1 million in superannuation assets, then they can do the full 3-year brought forward rule. Now, there was a rule that of needing to meet gainful employment. We no longer need to do that if you're up to the age of 75, and that changed on the 1st of July 2022. Beyond the age of 75, though, you're not able to do these non-concessionals. In fact, the only contributions going into super, apart from downsizer, what's that? That's when old people sell a family home. And you don't have to be that old anymore. You only have to be 55. That 300,000 of each spouse potentially being able to put into super. There's no other restrictions around that in terms of age or total super balances, etc. Or the other one is if we've got an 82-year-old who's still in the workforce as an employee, the employer still has to pay super guarantee, 11%, and you cannot salary sacrifice to do additional contributions to take it to the 27.5, and you can't do personal deductible contributions to increase that either. So there are other rules after 75. Now, of course, what didn't change this year was our concessional cap, our non-concessional, and the Division 293. I don't know, but I expect the concessional cap probably will go to $30,000 on the 1st of July 2024. Which will then take non-concessional to 120, because non-concessional is defined in the legislation as being 4 times concessional. And then, of course, the brought forward rule is defined as 3 times non-concessional. So potentially after 1 July 2024, those will be 30, 120 and 360. Now, your Division 293 so-called surcharge amount, that's just an amount that's set in legislation. It's not indexed. It's always open to any government to change that dollar amount. It used to be a slightly larger amount. I think it was 300,000 at one stage, and then it got dropped to 250, where it sat for a number of years. If anything, it definitely should go up. It probably shouldn't go down. All right. Now, the other change for super for the 2024 year is for the last few years, you only needed to take half of whatever the minimum drawdown was. Now, that was a temporary concession which the government of the day kept making from 2020 and kept extending. It started off as, sort of a COVID thing because people were worried their balances would be, reduced or wiped out by investment because of COVID, et cetera, which turned out not to be the case at the time. It's probably more of a worry right now, what's happening to your share portfolio. But anyway, we revert back this year to the actual prescribed rates in the legislation. I haven't put all of those on this table. Just if you're under 65, 4%, which was 2% for a number of years, 65 to 74, 5%. And if you're 95 and over, and A, you're still alive, and B, you've actually still got something left in your superannuation fund, then your minimum drawdown is 14%. Now, I do know of people who were quite happy only doing 2 or 2.5% over the last couple of years. That was enough to meet their needs with these sort of larger funds. And they're having to take out 4 or 5%. Some of them may or may not be able to get this back into super by non-concessionals. Obviously, that depends on 2 slides ago. Okay, let's move to cases. So this first case here is not technically just it's not really a tax case as such, although the Commission of Taxation was involved trying to enforce the payment of a tax debt. But it's certainly an issue that is relevant to professionals such as accountants, lawyers, architects, engineers, etc. Excuse me. Now, what happened in this case was Mr. Bosanak had for a number of years an ongoing tax dispute with the Commissioner. At the end of the day, all of his objections and appeals are all finalised. The amount of the debt is crystallised together with outstanding penalties and interest, blah, blah, blah. And that was several $1 million of debt which Mr. Bosanak owed to the Commissioner, which Mr. Bosanak didn't pay. So the Commissioner then goes to what's called summary judgment. And he basically looks around and goes, well, what assets are there that, could go towards meeting some or all of this tax debt? He looks over at the family home. The family home in this case was in Perth, in Peppermint Grove. Any of you who know Perth will know that Peppermint Grove is a fairly wealthy suburb of Perth, a very expensive suburb. A lot of the mining magnates live in Peppermint Grove, I understand. I'm sure there are people on this webinar today who possibly are from Perth. So the Commissioner looks at this house and goes, yep, a lot of value in this house. And I think this will go towards part of the tax debt. Now, the only problem from the Commissioner's perspective was Mr. Bosanak had no legal ownership of this property. This particular private residence had always been in Mrs. Bosanak's name only. This is not one of those situations where mum and dad buy a house together and a few years later dad goes, oh, I think I might have a creditors problem. I'll transfer half my ownership to my wife. On day one, this property was in her name only. Now, admittedly, it needed a $4 or $4.5 million loan to buy the property. And the loan was in joint names. And Mr. Bosanak, not surprisingly, made a substantial financial contribution towards that particular loan. So when the Commissioner goes after the house, the 2 competing legal principles here were the first argument by the Commissioner that although Mr. Bosanak did not have any legal ownership of this property, there was a presumption of a resulting trust, that the wife was effectively holding half of this property on trust for her husband, as evidenced by the joint loan, evidenced by the massive financial contribution he made, and also as evidenced by the fact that he also lived in the home with her. Now, the counter-argument from Mrs. Bosanak was this common law presumption of advancement, that the amounts that he had paid towards the upkeep of the mortgage and the house were effectively gifts to Mrs. Bosanak for her personal advancement. So it's a bit like, it's your daughter's 21st birthday and you buy her a $30,000 car for her 21st birthday. I'm sure she'd be very appreciative. And although you've paid for it, occasionally she might let you drive it, technically under the presumption of advancement, it's her car. All right, now in that case, it was a bad example because, it's actually in her name, and the commissioner can't turn around and say, well, it's in her name and there's a resulting trust. Well, he'd probably be highly unlikely to argue that in that sort of example, but he certainly argued that here. Now, on the top of the slide, you can see HCA. That stands for High Court of Australia. This case went all the way to the High Court. When this went to the full federal court, the full federal court had agreed with the commissioner that there was a resulting trust, presumption of trust. When it went to the High Court said, actually, no. The common law concept of the presumption of advancement applied, and the commissioner could not get his hands on this property. I might add, by the time we get all the way through the court process and whatever, my understanding is the property's actually been sold. Mr. and Mrs. Bosanac have split up, but she's got the cash, so the commissioner's after the cash. But in any event, the High Court says, Mr. Commissioner, sorry, you're not getting any of this. And as I said, the full federal court decision had agreed with the commissioner. So when that full federal court decision was handed down, most professionals, because this has been sort of standard asset protection strategy for professionals for many years, particularly in the good old days when accountants and lawyers, the only structure we were able to use was good old-fashioned partnership of individuals and all that fabulous joint and several liability that goes with being a partner in a partnership. Now, fortunately, our professional associations have become a little more modern in the sense of allowing us to incorporate our professional practices. But certainly in the good old days, when I first joined the profession in what seems like 1901, the only structure was partnership of individuals. So most partners in accounting firms, and I would expect in law firms too, owned nothing. The head partner in the big firm I used to work for, he was quite happy to tell anyone who was interested that he owned two things in life, a set of golf clubs and a surf ski, because everything else was in his wife's name and in discretionary trust, because that was standard asset protection. When the full federal court came out and said, sorry, it's available, that really sent a shiver down the spines of most professionals, but the High Court have said otherwise. All right, now there may be other issues around transferring of assets and personal bankruptcy and all this sort of stuff, which is outside my area of expertise. Having said that, that would be right in the expertise of, Worrells, who are running this seminar today. All right, but anyway, certainly the High Court has said, you can't go there, Mr. Commissioner. Okay, let's have a look at this case. This is also another interesting case, and this is on whether the engager of an individual, I won't call it an employer, I'll just call it an engager, do they have to pay super guarantee? Now, we've only had super guarantee since the 1st of July 1992, and there have been very few, if any, legislative changes to the way it works. There's been some minor changes, but in terms of the actual definitions of who is an employee, etc., there's been no changes to those, but we certainly have had various cases. And this is one of those cases. And this case is a case where the judge in the federal court said, yep, engager, you need to pay super. Full federal court said, actually, no, you don't need to pay super. All right, so what we're looking at here is, apart from the one of my attendees on one of my in-house seminars said to me at the time, because obviously trying to work out who's an employee, who's an independent contractor, etc., is quite important, particularly if your client is the engager. Because if you get it wrong and they get pinged for super, not only is the super guarantee charge not tax deductible, which is a big enough penalty in itself, but it's on top of what they've already paid to the contractor. And of course, then there's the interest component and there's the administrative component, etc. So it's a fairly expensive mistake to make. And one of my attendees said to me, so one judge says no super, next set of judges go, yep, there's super. And this person said to me, I'm just a mere mortal. How am I meant to make this decision when the judges can't work it out themselves? And I think that's a really valid point. Now, the full federal court, about to tell you the facts in this case, have gone no super. Commissioner is not happy with this case. So the commissioner has requested special leave to appeal to the High Court. So this case is not over yet. Okay, so what were the facts here? What we had was a higher education authority running courses, and it engaged this individual as a casual lecturer. He was actually a lighting and sound engineer. and he wasn't a common law employee. And I would agree that he most likely was not a common law employee. And they treated him as a contractor, and therefore they did not pay any super in relation to the amounts that they paid to him. Now, the question got down to whether this is a contract wholly or principally for labour. So when you go to Section 12 of the Super Guarantee Act, you start off with subsection 1, which refers to employees. So that takes the common law meaning of employee, the control test, the integration test. There are about 11 or 12 subsections in Section 12. So just because someone's not a garden variety common law employee does not mean you're off the hook. You need to keep reading. Now, the section that's usually the dispute in these cases that go to the AAT and the courts is subsection 3. Is our worker engaged under a contract wholly or principally for labour? So first of all, what does our lecturer bring to this educational institution? Basically, just himself. So that looks like a contract wholly 100% or principally more than 50% for his labour. However, if you have a right to delegate to someone else, it can never be a contract wholly or principally for your labour because you've got the right to delegate. Now, under this particular contract, if our worker was not able to turn up, next Thursday to do his lecture at 3 p.m. for whatever reason, he could actually delegate to someone else. But he had to get permission from the institution before that person was unable to, be substituted for him next Thursday afternoon. There was a written contract. There was obviously a degree of control in that written contract telling our individual, where the lectures would take place, and, what his teaching schedule was, and a general outline of the sort of things that he was meant to teach. He was paid on an hourly basis for his lecturing and for marking of exams. He would submit invoices now on a regular basis. Whenever he submitted those invoices, he had to attach his lesson plan. Now, this is after he's taught, though. So he's sending an invoice today for what he taught last week, and he's attaching his lesson plan for what he actually taught last week. He doesn't have to submit his lesson plan for what he's going to teach next week. So they don't have that degree of control over what he's teaching, apart from there's obviously a contractual obligation of what sort of objectives he's meant to achieve, etc. Okay, so the academic officer had some degree of control maybe over what he was doing. He had a right to delegate. Federal court judge said this is a contract wholly or principally for labour because he didn't have a right to delegate, etc. Full federal court go. First of all, the written contract is where we must start. Now, that comes off the back of another High Court decision, the CFMEU case and personal consulting. So it was a labour hire company. It was a case that the CFMEU brought in relation to contractors in the building industry getting jobs through this labour hire entity. And the short answer there was it was super. But the High Court said you must start with, if there is one, a written contract and what those terms are. In that other case, the CFMEU case, the contract said the workers were independent contractors, but then it set out everything they had to do. And basically all of those things they had to do just made them look like common law employees. All right, so start with the written contract. They identified the lecturer's ability to delegate, etc., and the invoicing and blah, blah, blah. Now, one of the big things the full federal court said was this guy, he does part-time lecturing. He's a sound and lighting engineer. Do you think this is the only place where he works? Well, clearly not. He's got a lot of clients. There would be some occasions, the court said, where it will be necessary for him to delegate to someone else because he can't turn up next week. Now, the example I've been using, just kind of getting a bit old now, is if you had, let's say, our sound and lighting engineer has just been appointed to do all the sound and lighting for the Taylor Swift concerts next year in February. Some of you are going, who's Taylor Swift? The other half of you are going, yes, I sat on my computer for 3 days trying to get tickets. All right, so let's assume he gets the job for the sound and lighting. He's clearly not going to say to the organiser of the Taylor Swift concert, well, that's great, but actually I can't do next week's gig on Thursday afternoon because I've got a 1-hour lecture at university. Clearly he's not doing his lecture that week, is he? He's going to delegate to someone. So basically, one of the things the full federal court said here was that it was a commercial imperative for someone like this carrying on a wider business to be able to delegate to someone else. So the conclusion so far is no super needs to be paid, overturning, as I said previously, the lower court decision. All right, what will the High Court say here? My personal opinion is they will grant the special leave application, and I'm actually not prepared to call which way the High Court's going to go on this one. So stay tuned, folks, and we'll see how that ends up. Okay, let's go to this case here. Now, this is a superannuation case. This case is a classic scenario of a blended family. Dad dies, and we all scramble for the death benefit. This case also highlights one thing I personally don't like, and that is individuals as trustees of self-managed super funds. It is perfectly lawful under the SIS Act, but I'm not a big fan for various reasons of individuals as trustees. I'm a big fan of appointing a corporate trustee. And now that we have special purpose companies, there's not much excuse really not to appoint a special purpose company. Although I was at a firm recently and said that, and they said, oh, we've got one. We insist on corporate trustees, but we do have one with individual trustee because this person has been banned from acting as a company director. Anyway, so that's an extreme case. All right, so let's go back to this case. This is all about the validity of a binding death benefit nominee. Now, what we had was the deceased, Mr. Williams, he and his late wife had a self-managed super fund. They were both trustees of that fund. They were both members of that fund. In 2014, his first wife died. Now, at that point, Mr. Williams had a choice of he could have appointed a corporate trustee with himself as sole director, but he chose to continue as an individual. So he needed another individual as trustee. So he chose one of his sons. So at that point, no issues with the SIS Act. We've got two individuals as trustee of a single member fund, no problems. All right, in 2019, Mr. Williams remarries. And at that point, Mr. Williams decided that he should do a binding death benefit nomination, and he left 50% of his benefit to his new wife and the remaining 50% of his benefit to his estate. His other son was the executor of that estate, and both of his sons were the beneficiaries under the estate. All right, so 2019, he's done what he thinks is the right thing. He then dies in 2021. So 2 years later, he dies. Now, the sons argued that the binding death benefit nomination was not valid because it had not been given to both trustees. Now, clearly, Mr. Williams, as trustee, had received the binding death benefit nomination because he signed it. So he effectively moved it from the left hand as a member to the right hand as a trustee. But the other son, the son who was the trustee of the fund, allegedly had never seen and was not aware of the terms in that binding death benefit nomination. So his argument is that the binding death benefit nomination is actually invalid. Now, what also happened was, not only are they arguing the binding, or the son was arguing the binding death benefit nomination is not valid, but after Mr. Williams died and before probate was granted, now remember the other son is the LPR, the legal personal representative of the estate, what they did was the son who was the trustee entered into a deed to remove the trustees and appoint new trustees. Now, this deed removed Mr. Williams, the deceased, as a trustee. Well, he's already dead. You can't remove someone by a deed when they're already dead. Now, at best, what happens is after probate is granted, the legal personal representative stands in the shoes of the deceased. But this removal of dad as trustee and the appointment of both the sons as trustees before probate was granted took place. Is that even valid? All right, now, so there's two issues here. We've got the two sons now allegedly the trustees. So now we have the new wife. Sons are arguing binding death benefit nomination is not valid. We're the trustees, and we have decided as trustees to pay the benefit to ourselves. Okay, so let's go to the court, Queensland Supreme Court. The court actually agreed, particularly under the clauses in the deed of this self-managed super fund, that binding death benefit nomination was not valid because it did need to be given to both individuals as trustees. Now, if we'd had a corporate trustee, first of all, you would only have had Mr. Williams as the sole director, sole member. But even if you had a fund, remember self-managed super funds can now have up to 5 members in them, so potentially 5 directors of the trustee company. But if a member signed the binding death benefit nomination and gave it to themselves as director, the company is deemed to have received that, unless there is some other more specific clause in the deed of the self-managed super fund saying all directors must receive the binding death benefit nomination, but normally serving it on the company would be met by serving it on one director. All right, so leaving that issue aside, court goes, it's not valid. Now, the next thing, though, was the wife had argued that the way the sons had appointed themselves as trustee and had chosen to pay the death benefit to themselves was inappropriate, and that the court should appoint an independent professional trustee. Now, given the behaviour of the son who was the alternate trustee in this super fund, and the judge had some fairly interesting, I'll say, things to say about that son, the court decided, yes, an independent professional trustee should be appointed. Now, who will get the death benefit? We will probably never know that because it won't go on the public record. But not only will the professional trustee, first of all, charge quite a bit of money to do this, so some of the super fund assets will be going off to, another authority, which perhaps ordinarily wouldn't have needed to have been paid anything. But the professional trustee, I guess, has a few options. Well, their first statutory option is to find all of the deceased's dependents. Okay, so the second wife, and the 2 adult children are all dependents. Now, admittedly, adult children are not tax-free death benefit dependents under the Income Tax Assessment Act, but under the SIS Act, they actually are dependents. All right, so I'm getting a sort of a wrap-up sign here that I'll keep talking for too long. We only have a few minutes left. All right, so as to how the professional trustee distributes that, I don't know. I actually have quite a few other cases I was going to look at today, but to be honest, the rest of these are AAT cases, so they're not as important. This one I will just draw to your attention. This tax agent decided to run this case and challenge the Commissioner's view that a distribution by a discretionary trust to a corporate beneficiary in 2009, when the Commissioner decided that UPE becomes a Div 7A loan, and the AAT have said, actually, no, it doesn't. Don't get too excited because I do expect the Commissioner to appeal that. Okay, there's a couple of other minor cases perhaps you can look at later. There are a few rulings I would just alert you to. The new personal services income rules, the new ruling on when are individuals a resident of Australia. That's mainly been updated for a number of cases that have been handed down. Withholding tax on employees, and that looks a little bit at super as well. And the PCG with that classifies workers as employees or independent contractors, which technically will need to be updated based on that JMC decision, but subject to the High Court. And very quickly, payroll tax and medical centres, this ongoing issue when medical centres make payments to the doctors who basically derive their own income but just pay the management fee across to this medical centre, where some jurisdictions have decided to treat that as relevant contractor amounts. We've had decisions agreeing that the medical centre has to pay payroll tax. We've had Victorian and New South Wales State Revenue issue their payroll tax rulings, reinforcing the position out of those cases, setting out those where some exemptions actually applied. But in New South Wales, we've recently had a bill that said, okay, for the time being, all audits will pause for the next 12 months. And any interest and penalties which might come out of these payroll tax assessments will actually not be imposed either. So we do have a 12-month pause on that. So that takes me to sort of with about 1 minute to spare, and there may well be a couple of questions which I think Crystal or someone was going to read out to me. So probably won't be able to take many of those. But anyway, if there are any questions that you want me to answer, Crystal, if you could just let me know.
Firstly, thank you so much, Jo. That was very informative, and I'm sure everybody online was able to take something out of that presentation. We do have a couple of quick questions so that we'll run through it. I know we're probably going to go a little bit over, so if anyone needs to drop off for other appointments, we totally understand. So the first question is a simple one. Is there a cents per kilometre rate for electric cars, for EVs?
Actually, yes, there is. Now, it's not so much a cents per kilometre rate. So what the Commissioner is looking at with electric cars, he does have a rate for, remember, electric cars are exempt from fringe benefits tax, but they are still reportable fringe benefits. So you still have to calculate the taxable value of the car fringe benefit under your normal rules. But you can always reduce the taxable value by the employee contribution. Now, if the employee is paying to have their car topped up at a, where you go and pay, I should know this because I have to do this from time to time, that obviously becomes part of the employee contribution. If they've got a home charger, for example, there is a specific rate, and I've now actually forgotten that off the top of my head what the rate is. But there is a rate looking at that employee contribution. Now, in terms of an individual, so we're not talking about an exempt FBT car, but an individual using their own electric car, there is currently no separate rate for electric versus petrol cars, which is kind of interesting because arguably, some of your costs are the same, your CTP, your rego, your insurance, new tyres, etc. But currently, there's no separate rate for electric versus petrol. So we'll wait and see if maybe the Commissioner issues something for the 2020, when he updates that for the 2024 year. Good question. Great question, actually. Thank you.
Thanks, Jo. And I guess sort of following on from that, with the small business energy incentive, is it applicable to the business car if the client upgrades to an electric car?
The energy efficiency, no. Electric vehicles are specifically excluded from that 20% boost. And so are solar panels.
Okay. Another question. Does the exemption for Medicare levy for lump sum in arrears also include an exemption for the Medicare levy surcharge?
I don't know the answer to that because this is not legislated yet. It doesn't start till 1 July 2024. So far it's just a budget announcement from March of this year, and the announcement just says exempting the Medicare levy for low income earners. I suspect the answer to that will be no, it will not exempt them from the Medicare surcharge if they're pushed into a higher threshold because of that lump sum. It would be a great thing for someone to, when we get draft legislation, to put that to Senate inquiry committees, as it should also follow through. It would make sense. Again, another great question. Thank you. But at this stage, I don't believe there's any intention to exempt the Medicare levy surcharge for people who don't have private insurance. It's very much directed at lower income earners. Thank you.
We've got a couple more quick ones. How long can New Zealand citizens be regarded as temporary residents for Australian taxation purposes?
Currently, indefinitely, as long as they hold that subclass 444 visa, which basically when they arrive here, they can stay here indefinitely unless they commit a crime or whatever. They just continue at the moment to be temporary residents for tax purposes. Yeah.
And then to use the downsizer contribution, is it okay to contribute the $300,000 if the residence was used partially to run their partnership business?
Okay, so to get into the downsizer contribution, the basic criteria are you needed to have owned the main residence for a minimum of 10 years, and you have to be entitled to a full or partial main residence exemption. So if you've got a property that you're only getting a partial main residence exemption on because you've run a business from home or whatever, you still get into the downsizer contributions. But what that means is you can't elect, your holiday house that you've owned for the last 15 years that has no main residence exemption at all. You can't use the downsizer contributions there. So you have to be full or partial main residence exemption. Another good question.
Thanks, Jo. Final one, we have encountered a situation where the small business tech boost has resulted in a tax loss. Then this was used to claim a loss carryback tax offset, The ATO have denied this, however. We have not seen any legislation, rulings, etc. that disallows this.
Okay, so this is the 20% tech boost. which started in March 2022, but the first time you could apply this was lodging 2023 returns. So you potentially in a 2023 return have maybe the boost for the last 3 months of the 2022 year and maybe the boost for the 2023 year. So maybe a maximum $40,000 deduction because that one's capped as well. So yeah, that's created a tax loss. Now, this is a great question, and it's a really good question. I actually can't answer this straight off the top of my head. As far as I am aware, if that creates a tax loss, you're still able to carry that loss forward. But what we have here, the questioner is saying they've actually used that loss for the 2023 year to carry backwards, and the tax office have said no. I'm not aware of a specific provision that prevents that from being carried back. I will stand corrected on that because I've not specifically looked at that, and that definitely is going to get the Gold Star Award for best question of the day. And I'm sorry I can't give you an absolute answer on that, but I will find out the answer to that. And I don't know, Crystal, is there any way you can broadcast that answer to your members some way in the future? Do you do a newsletter or anything, or?
Yeah, sure, we can. We've actually got CPD certificates with a copy of the presentation and the recording of the presentation going out tomorrow. So we definitely have a list of attendees that we could circulate some further information for later.
There may be some other people who have that same question. So yeah, thank you so much for that question. That's great.
That's all the questions we've got today. So firstly, thanks again, Jo, for such a great presentation. We really appreciate you joining us today. Thanks again to everybody who's online. Huge thanks for attending. We've got over 1,000 attendees online today. So thank you for coming along. As I just mentioned, CPD certificates as well as a copy of the slides and the recording will be circulated to all attendees tomorrow. Also just wanted to quickly mention that we have our next series of breakfast and lunch seminars coming up in November. So we'd really love you to come along and catch up with everybody at that seminar series before Christmas. And that's all we have time for today. So thanks again for attending, and hope to see you online again next time.
And thank you for inviting me along today.
Thanks, Jo.